Welcome to the What You Need to Know Regarding Garnishments webinar. Payroll garnishment is typically initiated through a court order or government agency. It requires the employer to withhold a percentage of an employee's compensation. When we're notified of an order to garnish wages, we are legally obligated to make the appropriate deductions from the employee's wages and make direct payments to the designated agency or creditor in the payroll following receipt of the order. Wage garnishments can be initiated from a few different entities. Each of the entities named here have the legal capability of seizing assets depending on the type of debt owed and the applicable laws. Receiving a notice of a garnishment typically involves a formal legal process. The specific procedures can vary depending on the type of garnishment and the applicable laws. If a creditor decides to proceed with the garnishment, they must obtain a court order or judgment authorizing the garnishment. Once the court order is granted, official notification is sent. Here is a list of the most common types of garnishments that you might encounter. Federal agencies and federal student loan holders can garnish up to 15% of an individual's wages. Keep in mind that garnishment limits are set by the Consumer Credit Protection Act and do not apply to unpaid taxes, child support orders, bankruptcy orders, and student loans. So what is the Consumer Credit Protection Act? This law protects consumers and sets how certain commercial credit agreements should be conducted. Garnishments have different levels of priority when withholding from wages, with child support orders having the highest level of priority. This is followed by bankruptcy orders, federal tax levies, administrative garnishments for federal agencies, state and local tax levies, and then creditor garnishments. Federal law is not very clear on the priority of student loan garnishments. The rules on the priority of multiple wage garnishments for the same employee vary from state to state. However, garnishments for child support orders always take precedence unless a federal tax levy is already in place. Disposable income is the amount of money available to an employee after taxes have been deducted. Those taxes include federal income tax, state, and possibly local tax. This also includes Social Security and Medicare tax, also known as FICA. Child support orders have different percentages that can be deducted from an employee's disposable income. The percentage differs depending on the employee's family situation. Virginia has adopted the Uniform Child Custody Jurisdiction and Enforcement Act for child support orders. This act provides that the child support orders entered in another state will be recognized and honored by the Virginia courts. This slide is just an example of how a child support order would be calculated if the employee was supporting a second family and was not in arrears. The biweekly amount is entered into Dayforce and is an ongoing deduction from the employee's paycheck until an amended order is received or a termination order is received. Dayforce will ensure that the maximum amount allowable under federal law is withheld. As you can see in this example, the allowable amount that can be withheld is $577.50, not $808, which is the amount indicated on the order. If the amount withheld is less than what the order says, the remainder is added to the employee's child support arrearages. Lump sum payments are considered employee income and are subject to withholding to collect child support. If you have an employee with a child support order that will be receiving a lump sum payment and you require assistance on how to withhold, you can contact the Virginia New Hire Reporting Center via email or by phone. If an employee should terminate with an ongoing child support order in place, it is your responsibility to notify the Child Support Enforcement Agency immediately, providing them with the termination date and the employee's latest address if known. It's important to note that this not only applies to child support orders, but any garnishments you may receive for a terminated employee. The garnishment of wages for a federal tax levy will occur if an employee does not pay taxes owed or does not initiate a plan to settle the debt. The IRS then determines that a levy is the next appropriate action. This slide goes over the steps that need to be taken when you receive a federal tax levy. Details can also be found on FreshDesk by searching federal tax levy. Net disposable pay is the amount that an employee would normally take home using the W-4 that is in effect prior to receipt of the levy, minus the normal payroll deductions for income tax and FICA taxes. This also includes normal deductions such as 403B contributions. In certain cases, the IRS will notify the employer not to allow a certain deduction, such as a 403B contribution. In this situation, the employer should follow the IRS's instructions. Employers cannot accept a revised W-4 form from an employee following receipt of a federal tax levy. Virginia state tax levies withhold at 100% of disposable earnings, but employees do have the option to contact the agency that initiated the order and work out a payment plan. Keep in mind the terms of that payment plan need to be received at the CAO prior to committing the payroll. If you should receive an amendment to a previously received state tax levy at your location, please be sure to submit the change through FreshDesk immediately using the category garnishments so the update can be made in Dayforce. Federal law limits the amount of earnings that can be garnished to 25% of the disposable income or the amount of the employee's disposable income that exceeds 30 times the federal minimum wage, which is $7.25. In this example of a creditor garnishment, the employee has $500 in disposable income. 25% of that is $125. The amount that exceeds the federal minimum wage is $217.50. Therefore, the most that can be garnished from the employee's wages is $125, which is the lesser of the two. Voluntary payroll deductions may include deductions for health insurance, life insurance, retirement plans, or other job-related expenses. These are payroll deductions that an employee opts into. Generally, if a voluntary deduction is in place before the garnishment order is received, it should remain in place and will be omitted from the disposable income calculation. Depending on the order, sometimes premiums can be included in the disposable income calculation. However, at this point, the voluntary deductions cannot be increased to avoid payment of the garnishment. This is why it's so important to read all orders carefully to ensure you are in compliance. An employee cannot be terminated because he or she is garnished for a debt in Virginia. Different states have different regulations, but most states follow federal law. Upon receipt of the garnishment at your location, you should date stamp the order and create a ticket in FreshDesk using the garnishment category and forwarding the order to payroll support. The payroll department at the CAO will enter the garnishment into Dayforce for you. Once that has been completed, the CAO will notify you and provide you with a letter to give to your employee. It then becomes your responsibility to monitor the garnishment deduction and payment to the agency and to answer any current or future questions regarding the garnishment. Remember, you are the point of contact for the employee and the agency regarding any garnishments. Some garnishments require you to contact the agency prior to the final payroll deduction to validate the total amount due, as interest may have accrued on the balance. Therefore, prior to stopping the deduction, a call to the agency is required. In these situations, please have the issuing agency send written documentation to you and then submit a ticket through FreshDesk using the category garnishment, and we will make the update in Dayforce for the final deduction. Remember, only the issuing agency can release a garnishment. If an employee sends or comes to you with a payment receipt of the garnishment in question, that is not sufficient documentation to release the garnishment. The release must come from the issuing agency. When an on-site check is needed for an employee with a wage garnishment, The payment of the garnishment deduction to the agency must be manually requested from Dayforce's Wage Disbursement Department, either by calling the Wage Disbursement Department directly or emailing them. This process cannot be done directly through Dayforce. The wage garnishment deduction will appear on the employee's on-site pay statement and the payroll register the check closes out with, but it will not be automatically sent to the garnishing agency as it would with a system-generated check. There is a disconnect between on-site checks and the Wage Disbursement Department's automated process. There may be times when you receive a release from the issuing agency after you have already committed the payroll. In such cases, you will be able to void or stop the payment that is scheduled to be sent to the agency. Again, you will need to contact Ceridian's Wage Disbursement Department directly. If the release is received after the allowable time period and the funds have already been sent, the employee will have to contact the agency directly to receive a refund of the amount that was withheld and submitted to the agency. If you are able to stop a scheduled payment, you must refund the deduction amount to the employee and record that refund in Dayforce. This can be done via an on-site check. For further instructions, refer to the document, How Do I Refund a Garnishment Using an On-Site Check in the Next Regular Pay Run? Don't forget to send a copy of the garnishment release to payroll support through Freshdesk so we can end date the garnishment deduction for you in Dayforce. Just keep in mind that you can always submit a ticket through Freshdesk if you should need assistance in any of these situations. You are responsible for monitoring all active garnishments in Dayforce for your location. Monitoring includes checking the employee's pay statement to make sure the correct amount is being withheld. This can be done on the employee's flyout during payroll processing before committing your payroll, or by reviewing the employee's garnishment deduction on your payroll register preview. Again, this is done before committing your payroll. You can also check the garnishment register report in your archive reports. This report will not only provide you with the amount being deducted, it will also provide you with the agency that the payment is being sent to. Remember, you are the point of contact for the employee and the agency regarding any garnishments. Please do not forward your employee or the garnishing agency to payroll support. Please do call us directly if you are unable to answer any questions from employees, and we will assist you in answering those questions. Remember, you must contact payroll support prior to accepting your payroll if you believe that the garnishment deduction is not being deducted or is not in compliance with the order. Also, it's important to note that the garnishment funding withdrawal will be a separate line item on your payroll summary report and will be a separate withdrawal. If you should have any questions regarding garnishments, please submit a ticket in Freshdesk using the garnishment category, and we will compile a Q&A answering all questions.